So first, I'd like to welcome everyone to our private credit and yield investor evening. I was just thinking to myself how much I've forgotten about doing investor evenings because we've been doing day-long conferences, but obviously this is a specialty area. So we wanted to host an investor evening, but I forgot about the way this works. That typically at 5:52, I'm typically freaking out about how many people are here, and then all of a sudden everyone leaves their offices and comes. So thank you very much, everyone, for coming tonight. So this area of private credit and yield has been obviously a strong area of focus for the last sort of 18 months. And, Wholesale Investor, we've become known obviously a lot in the venture space. And sorry, can everyone just make way? Just room for people still coming in. We've obviously become known in the venture space, in the first 4 years of our life. We launched in 2008. It was in 2012 we decided to host our first fund manager event. And it was sort of highlighted to us by an actual fund manager where he said, look, the reality is a lot of your subscribers, they're typically high net worth, family offices. They've got 5 to 10% of their portfolio sitting in, like high risk ventures, like the stuff we showcase, like our life science companies, renewable energy companies, etc. He goes, but they've got their other portfolios allocated to, things like property, funds, etc., and other high yield opportunities. And so that's why we started to do our first fund manager event. And to our surprise, it was a great success. And then every year we have done that. I think even in the COVID years, we did a yearly fund manager and property event, during that, but we actually obviously had to do it sort of online. So tonight, we specifically title this private credit, and mostly because the media has just built up so much hype around this. But the truth is, for the last 18 months, it's been a high yield environment, which has meant that from an investor's perspective, there's some great opportunities for you to get access to as part of this. And what's really lucky for us, we've got an ecosystem of people, and some of the people that are actually presenting tonight are on our subscriber base as investors looking at venture opportunities, but also just happen to run these types of opportunities that we're sort of talking about tonight. So to give some sort of highlight, we've worked with some incredible firms over the last 18 months that are quite well known. You probably would have seen some of the venture capital funds we've worked with. We've worked with PEP as an example, the private equity manager, and also the likes of Palace Capital, who pretty much everyone in this space seems to know. And in that, it's what I love about what we do is not only do we get to work with the experienced managers, but we also get to work with new managers as well. So another example of, someone who came to us new at the start of last year was Ben Greentree from CCS Developments. And if you've been following on LinkedIn, you've been seeing the progress of some of his sites. He's got some incredible people on board with him. And, they're going through their own execution milestones right now on some of their projects. So it's a great opportunity for you as an investor to get access to new managers, but also experienced managers. And then, of course, we want to have a panel session tonight so that you can actually learn from both people that are active in this space already and also from a family office perspective as well, how they're looking at things. Because the way I always think about what we do as Wholesale Investor is that our job is to not, tell anyone what to think. We just want to put people in front of you that can give you new ideas or new layers, or maybe just reinforce your own investment, your own investment thesis about how you're approaching things. As I said, this is a unique market, where because of the high interest rates, it's created unique opportunities. And tonight, the people that are presenting, the majority have anywhere between 5 to 30 years of experience in this space. So to kick off with, and obviously I'll mention with the panel, as I mentioned, we've got Chris Broad from Left Field Capital. Now, Chris works with Greg Paramore and Left Field Capital as part of the Paramore family office. Once again, Greg's been an incredible guy that I've had the opportunity to work with since 2012 under the Folkestone banner, and him, Adrian Harrington, and they're an incredible resource for investors and actually just really great people as well. Mike Davis from Causeway Asset Management said, I've known Mike for nearly 10, 12 years now, really strong focus on that sort of business financing area. Sort of, probably unknown to many, but done an incredible job building their loan book, building success, building track record, and obviously get to hear from him, his insights. And then we've got Francis from Capstones Funds, focused on the residential credit, property credit side. And then Sterling Property for Scott Girard, and I'll give a bit of an introduction to Sterling in a second. And then Sam Sproats from Growthpoint Properties, who I'll also give a bit of an introduction to because they've also got a very impressive track record. So tonight, as part of my introduction, I'm going to give a bit of a high level for the companies that are participating whilst I look at my countdown. So one of the first companies, like I mentioned them this time because apparently last event I forgot, so I apologise for that, Mark. I was really impressed the first time I spoke to Mark from Mortgage Back Investments. 30 years actually in this space, doing it himself, doing it off his own balance sheet and building a team around it. He's obviously seen that this market has created a whole range of opportunities for the specific area that he's involved in. And so he's going to be presenting about what he's doing. And I always love it when I come across people that most people won't know, but have got, I said, decade years of experience in track record to speak about what they're doing. Very humble guy, an incredible team that he's actually built around him. We've also got Princeton FS Financial Services, who was founded in 2012 and achieved a 4-star high investment grade rating from SQM Research. Once again, strong team, strong track record, and the founder's whilst this has been since 2012, the actual founder has been doing in this space since for the last 20 to 30 years. Then we've got Sage Financial. First time I spoke to the guys from Sage Financial, they mentioned to me about how they'll focus on the reverse mortgage market. To me, this is a no-brainer from a market perspective over the next 10 years. Given the amount of baby boomers that want to access equity, inside their own homes, but may not have incomes or may have retired, etc., this has become a key growth area. Strong team again, great experience in this space. We've also got Deltine Capital. So I'll give a quick introduction to Dave Toomey. The best way I can say is I've known David now for, I think around 14 to 15 years. And for the last 7 years, he went quiet. And then when he reached out to me, I found out the reason why he went quiet for the last 7 years because he was busy building a business that he actually went and listed on the NASDAQ, which I know very few of us can say that we've been able to do that in our lifetimes. And now he's gone and he spotted a unique opportunity across the hotel motel space in regional areas, and he's created a clever financial product around that with high potential growth and also high income as well. We've also got Sustainable Concrete Solutions. Now, not quite typically private credit, but a very unique private equity, let's call it roll-up play, where what they're looking to do is to acquire concrete businesses and then add a sustainability layer to those businesses to then go and increase their product offering to the markets they're going to. Now, of course, the ability to acquire businesses at a sort of 3x and then go and build additional layers of sustainability and also growth, quite unique in that area. We've also got Growthpoint Capital. As soon as I saw this opportunity, I knew it'd be of interest to our investors. It's a Canberra-based project. They've got a target IRR of 16%. They've got 9% distributions and 88% government tenants. And so, as I said, knew that would be an ideal opportunity for our subscribers. And then last one I was mentioning is we've got Sterling Properties, and I hope I haven't forgotten anyone. We've got Sterling Properties presenting. I first worked with the owner of Sterling Property, Matthew Hyder, 12 years ago for his first business, which was Legacy Properties, which was focused around building assets for residential. That business has done incredibly well. Likewise, have the projects. We've been working with Sterling now across some different projects for the last 5 years. This last one, as soon as he asked me what was my thoughts on it for the investors, when it went out to our database, it actually lit up, on the emails as far as how much interest they receive. And the simple reason for that is that they've got, as tenants, they've got Bunnings. They've also, to give you an idea, Bunnings is a tenant and they've got 93% of their tenants that are national brands, a target IRR of 14.9%, which is 18.7% tax adjusted and 7.1% distributions. So the point I'm going to highlight is that every single one of this, I've gone through the process of curating opportunities for tonight. And I know there's also some incredible people in this room, both from the funds management, family office, high net worth that we've sort of had experience with for many years. So tonight, we've got a great lineup of companies that are presenting today. Now, how it's going to work, the companies are going to present. And then obviously inside Capital HQ, We've made it super easy for you to get access to the opportunities and request interest. We've mentioned them all in the emails which have gone out today. Everyone's got trade tables at the back. Now, the networking part is going to be out here. So we're going to do our best to make sure that each company has a cocktail table and a banner out here as well, so you can connect with them after the actual event. If there's an opportunity which particularly strikes your interest, I suggest you may want to have a chat with them after their presentation as well. But as I said, you can find all their information inside the Capital HQ deal rooms. It's very easy to access on your mobile. And also, likewise, all the companies featured tonight are sitting inside. All you have to do is just go in there. You'll see the private credit investor evening on top. You'll be able to access it up there. And then the final thing I'll always say is that never underestimate the power of one conversation. Every single event, every single conference we host, we see the difference that one conversation can make, whether it be for the trajectory of an opportunity, whether it be sometimes a relationship with us, or whether it be the people that you meet and the networks that you can add value to. Now, the second part to that is, whilst we've got a whole bunch of people here tonight, we've got a full house tonight. I always say that there's always going to be 10 to 15 people in your network that some of the opportunities could be relevant for. So whilst this night you're here to learn about the different opportunities, I strongly recommend that think about any people in your networks that the companies and opportunities could be relevant for as well. And then also to note that we're going to be finishing tonight with the panel session that I was mentioning before. So, and then what's coming up for us? If you're going to be in Singapore next week, we're hosting our Venture and Capital Conference in Singapore. We've got 450 investors coming along to that. Singapore is one of my favorite, as you all know, Singapore is my favorite destination to go to. The focus for that is going to be around, obviously, Australian private credit opportunities for Singaporeans, because obviously, Singaporeans like yield. And also, we're going to have a strong focus on high tech, life science, and also energy and sustainability, because that's also strong focuses for Singapore. We're going to be hosting an investor demo day. It's going to be startup and scale up focused at the end of October. And then if you want to fly down and join us in Melbourne, we're going to be hosting an event in Melbourne as well. And I just want to give a quick little shout out to seeing the Rapid Response Revival team here tonight as well. Said, even though that's sort of not in the theme of tonight, love working with those guys. If you think about the famous story of Kerry Packer, when he almost died, in the back of an ambulance, but he was in one of the 3 ambulances which had, what are those machines called? Yeah, the defibrillators. These guys are helping to actually bring those defibrillators into everyone's home so they can have their own solution at home. So I love that, I love that we can bring that kind of technology to our ecosystem and to our investors. So on that note, I'm going to hand it over to Jade to be the host for tonight. Enjoy your evening and look forward to networking with you all at the end.
Good evening, everyone. My name is Jade and I will be your MC for today. Let's kick things off with our first set of company presentations. Please join me in welcoming Mark Adams, Managing Director at Mortgage-Backed Investments.
Good evening. Thank you, Jade. Mark Adams is my name. First presenter of the evening. I get to warm you all up. Yay. See a couple of friendly faces. Mortgage-backed investments. Mortgage-backed investments offers reliable returns in a dependable capital preservation structure. Specifically, standalone fixed return commercial debt investments secured by first mortgage over real Australian property. Whilst each opportunity is standalone, every opportunity will have strong risk-adjusted returns. Every opportunity will be for shorter terms, 6 to 12 months. Every opportunity will be backed by a first mortgage. And importantly, every opportunity will be in the under $10 million market space. The market. Traditionally, provision of commercial debt for construction and development has been provided by banks and other deposit-taking institutions. Most of you in the room would be familiar with the rise of the non-bank lender in the last 10 or 15 years. Demand in that market is strong and it's growing. Our investment manager, Queensland Capital, is a non-bank lender, and they've found that by offering funding options for developers and builders on terms that are clear, concise, and timely, they're often able to achieve rates that are higher at a premium. The strategy or the opportunity is to allow investors to participate in those loans and to share in those higher rates. Again, each opportunity will be backed by a first mortgage. Each opportunity will be for shorter terms, 6 to 24 months, and each opportunity will be in the under $10 million market segment. Returns. Presently, returns are in the 9 to 10% range. That compares very, very favourably to deposit rates and historic dividends for Australian shares. Importantly, those returns are not affected by management fees. The investment manager subordinates its fees till after return of investment capital and payment of projected earnings to investors. Investors can choose to have their return paid quarterly or compounded to the end of the loan. Security. Mortgage-backed investments works off a conservative loan-to-value ratio. Conservative loan-to-value ratios are an important risk mitigation tool. They provide significant headroom to provide return of capital and payment of investor earnings in the event there's a problem with the loan. As every loan is backed by a first mortgage, these conservative extensions, usually 65%, mean that for every $65,000 that's extended to a borrower, there's $100,000 of property security backing that loan. Again, with security, mortgage-backed investments does not do second mortgage. We only do first mortgage. There's no hybrids, there's no blending. It's just first mortgage. First mortgage is repaid in priority ahead of second mortgage. It's paid in priority ahead of preferred equity. It's paid in priority ahead of the borrower's own equity or funds in the company. There's no pooling, important point I should make. There is no pooling, so the performance of one investment loan cannot be affected by the performance of another or the actions or decisions of many investors. The market segment. As I mentioned, mortgage-backed investments chooses to operate in the under $10 million market segment. The under $10 million market segment is not exotic. You won't find us providing offerings for high rises in hotspot locations. The under $10 million market segment across the country is solid, everyday, in-demand product. We feel that the under $10 million market segment has got some different risk-return metrics. Specifically, the design is usually less complex, which means the approval is less complex. The building is less complex. If you have a problem with the builder, you can find a replacement contractor. You're not having to find and negotiate with a tier one builder. Because they're less complex, they're in the market for a shorter time, which means there's less exposure to market movement in demand or appetite for the product, and less exposure to potential cost creep for construction. They're usually smaller, which means there's less of the product to sell to realise the capital, and usually in a lower price point. Co-investment. The investment manager, Queensland Capital, co-invests in every deal alongside investors. They will be a minimum of 10% into every deal. They offer that investment as a first loss to investors, which means they would have to lose every cent of their investment before there is any risk to any other investor. Additionally, they subordinate their investment management fee behind return of investors' capital and investors' earnings. We feel that that structure ensures that there is aligned, focused, and motivated management in each deal. Who is the investment manager? Who's Queensland Capital? Well, Queensland Capital is a non-bank lender specialising in the under $10 million market space. The shareholding structure of Queensland Capital is the same as mortgage-backed investments. We are the same people. Our track record. Thank you for calling me old there, Steve. I don't know where you got the 30 years from. I've been doing property for 30 years, but I've only been doing this for 15 years lending. The track record of Queensland Capital since 2016, we have assessed over $4.8 billion worth of projects. We've chosen and gone ahead and funded $404 million worth of projects. We've injected $133 million of our own money into projects, and to date, zero capital loss. The investment structure. At the heart of every investment or every loan opportunity is an SPV. Every loan will have an SPV. We are not pooled. The SPV holds security over the end borrower, and holds the first registered mortgage over the subject property. Investors hold security over the SPV. The custodian, we currently use Computershare, holds investors' funds until all security is in place. Who can invest? We see investments with mortgage-backed investments appealing to a wide range of people, individual investors, self-managed super funds, indeed other funds and trusts. Our AFSL obligations mandate we can only take investment from professional, wholesale or sophisticated investors. Some quick examples. Here are two that are available at the moment. You will see that they are both in the sub $10 million space. They are both for short terms. They both have co-investment from the investment manager. They're both backed by first mortgage, and those two happen to be both at 9%. How is mortgage-backed investments different than other property funds or indeed debt funds? Well, the investment manager co-invests their own money beside each investor. They offer that money on a first loss basis. They subordinate their fees behind return of your capital and your projected earnings. Every loan is backed by a first mortgage. It is not pooled. Every loan is for short terms. And every loan is backed by security in the under $10 million market space. How do you start investing with mortgage-backed investments? Well, it's very straightforward. The first step is to go to the website, mortgagebackedinvestments.com.au. Register there. From there, you'll receive opportunities as they arise for you to consider on a no obligation basis. You may invest in more than one opportunity at one time. There's a minimum of $100,000 investment into any one deal. The website again is mortgagebackedinvestments.com.au. My name is Mark. I'm up the back. If you have any questions, please come along. I'll do my best to answer them for you. If not, go to the website. There's a form there, a contact form, and we'll come back to you and answer your questions. If you do find yourself at the end of the evening wanting dependable, reliable returns and a dependable capital preservation structure, I urge you to consider mortgage-backed investments. Have a good night, and I wish you all success in your investing.
Thank you, Mark. Now, please join me in welcoming Sam Sproats, Executive Director of Funds Management at Growthpoint Properties Australia.
Good evening, everyone, and welcome. Thank you, Steve, for the opportunity, and we're pleased to be here in front of you all. My name is Sam Sproats. I am the Head of Funds Management at Growthpoint Properties Australia, joined today by my colleagues Catherine, Annabelle and Samantha. Growthpoint Properties Australia is an established investment manager specialising in commercial real estate. We're across industrial, logistics, office and retail sectors. We currently own 66 assets across the country. You can see the spread between the sectors. Directly owned, we own $4.4 billion worth of real estate. And in our funds management business, and that's specifically why we're here, we currently own $1.6 billion worth of real estate. Steve said so, show something about your track record. There's a lot of data, a lot of facts here, and I'm not going to go through those, but we can demonstrate in the funds management space over 31 years of success, investing over 100 properties across Australia and an average 17% IRR over that time period. Why? We like real assets. We know what we can do to real assets, and that's drive income. But why now? And I think this is the most important part of why the opportunity is now. Uncertainty and dislocation in markets create opportunity. So if you're looking in the middle section, uncertainty is what attracts us right now. There has been significant adjustments to pricing, and that's what you can benefit from right now. Development, and I'll respect what was said just earlier, but point 3, development is going to be constrained going forward in commercial markets. Commercial development doesn't pencil as well as it used to for all the different reasons, but mostly in a high interest rate environment. This will be good for existing assets, and we've got one to present to you tonight. And then always you're looking at robust fundamentals of the Australian real estate market. What we offer to you is, we've seen this before, we've been for 33 years in total in funds management. We've seen cycles, and we like to talk about vintages. And if you look on the far right, this is what we're most excited about now. Now is a very exciting and interesting time from a vintage point of investing. What has changed very, very recently, and I'll just draw you to the bottom right, there has been such a drop of transactions, or a reduced amount of transactions in the market, well below 10-year averages, but well below, if you look all the way back to 2008, and we remember those times. We remember those times because we were in them. We were still doing what we're doing now in funds management. But the most exciting part on the bottom right is it's about to change, and change is what we're about. So, of course, we're here to promote and sell something. I better look at the clock as well. We're here to promote and sell an investment to you, and I mean it in that. 3 key points. Deep value always. Buy well. No matter what we're doing in investing, always buy well. We're buying cheap at the moment, and I'll get into that as to why we believe that. Counter-cyclical investments. Everyone loves to talk about counter-cyclical, and you've got to be brave to generate the returns that we're proposing, and brave enough to say that 88% of the income that we're proposing is generated from the government. We love government. Government pay the rent on the first day of the month because that's what they're contracted to do. They're a perfect tenant. So that leads us to the second point, which is about high yielding, and I think that's what today's all about, creating opportunities for investors to consider what is the best option for a high yielding return. Third point is really important from an investor perspective, and that's responsible investing or impact investing. What can we do to the real estate to enhance value and also mitigate the risk of real estate? Targeting a net zero strategy and improvements to both neighbours' ratings and operational efficiencies is exactly what we do. We have an ability to leverage off an in-house capability, but an opportune time in the market that attracts government tenants. We are talking about Canberra, and Canberra is the capital city of Australia for government tenants, but how we can attract tenants, but also retain tenants. And that's what you want, sustainable, regular cash flow. So what excites us about this opportunity? You can see on the far right, the location, which is highlighted, but the return profile is what we like. This is the best deal that we've seen in market for over 2 years. What attracts us is 9% distributions to investors after fees. Paid quarterly, strong distributions to investors. A target IRR over a 5-year period, 15 to 16%. Lots to do to get to that return. A lot of it through the income, so that's good. The other piece is how we're going to improve the value of the real estate by the improvements and enhancing its quality. And I think that's a very important factor for investors to consider, which is an equity multiple, a 1.85 times over a 5-year period. So very simply, $1 in, $1.85 out over a 5-year period. 3 things to mention on this slide. There's 6 things, obviously. Top left. 9% distributions, I'll say it again, and it's the most compelling reason to invest in this piece of real estate, where 88%, as Steve mentioned, is generated from the government. Fantastic, that is secure. Deep value buying in the middle at the top. We're buying this at $4,600 a square metre. That's a great metric when you're talking about real estate investing, because to build that now will cost $9,000 a square metre before you buy the land. With the land, it's somewhere between $11,000 and $12,000 a square metre. And that's before you need to put a profit and other metrics onto development. And then the bottom left is about how we can improve the asset, electrification. We've got a sustainable energy grid down in Canberra, and then targeting the energy performance. So a neighbours energy, National Australia Built Environment Rating System, how we can improve the asset and its performance to attract and retain tenants. Real estate investing, it's all about location. Everyone knows that. This is the strongest location in the Canberra CBD. Bottom right is where the ACT government and most other government departments are located. In the middle on the top right would be the centre of town, which is, you can see the Canberra Centre, identifies where the centre of the town is. And and it's a very strong location. More importantly, we already own 3 assets in this market. We own about $211 million worth of real estate in this market. We are in it, we understand it, and we've got people on the ground. Too much detail on this as well, and we're very happy to explain further what it means. I think the most interesting parts here is institutionally owned. We're buying off an institution that is really incentivised to sell their real estate. They're going through a re-rating, a readjustment. They call it non-core strategy for their real estate. We love that opportunity. When we hear that, our ears prick up indeed. What we can do to the asset while we've got tenants in place, and how do we lease up? There's a small amount of vacancy. It's 4% in the top bullet point there. Very simple things to do. Value add strategies. We've been doing that for 33 years, a value add specialist in the Australian market. From an investor perspective, so what does all that mean? So this is an SPV, was touched on before. It's a single asset investment opportunity. We are acquiring the asset for $90 million, $4,600 a square metre. We've got a sustainable level of gearing to introduce into the asset, and we're raising $54 million. We started our raise just over a week and a half ago, and we've got 2.5 weeks remaining, which takes us up, you can see the 18th of October is the key date for applications to be received and monies to flow. From an investor perspective, we're a wholesale investment management business, so it's a minimum of $100,000 and multiples of that. We see this as compelling. The return profile on the left-hand side should interest you. I'm again joined by my colleagues. We'll be also in the back corner and really happy to have engagement and any conversations about this opportunity. Thank you for your time, and I'll hand it over.
Thank you, Sam. And up next is Sage Shield. Please join me in acknowledging its investor relations, Paul Hewitt.
Good evening, everybody. Great to be here, and thank you for your time. So Sage Shield, we focus on bridging generations and building prosperity. And our aim is to build a legacy profitably, helping Australians who perhaps we owe the most, our retired generations, those that have worked 40 years and have built the economy that we enjoy the most. There's nothing new I'm going to tell you tonight. I think we know all of the figures that I'm going to provide you, but it's putting it together and allowing you to participate in perhaps how we can assist this generation profitably for you as investors. Okay, so the aims of today. We are looking at a situation where our current retirement funding model through age pensions, super and savings, the traditional funding model is not feasibly going forward going to provide our retirees with what they expect from retirement itself. We exclusively represent a company called Australian Seniors Advantage Group, a provision of equity release in reverse mortgages specifically. The product offering has a super low risk on an LVR of 16.2%. We give guaranteed monthly distributions and our returns at 7.85%. So today's presentation, we'll look at what it is, the paradox in relation to Australian retirement, what is a reverse mortgage, supply and demand factors, international comparison of how we stand, and Australian property as a security lending into your participation. As I say, 16.2%, super low risk, monthly distributions, and 7.85% retirement. So what is the retirement paradox of Australia? Well, firstly, we have the world's richest retirees. The net worth is 80% made up by fixed assets or property. They're the longest living with the healthcare system that we have. 1995, we had 15 years of retirement life. Today, on average, 28 years to fund. It's not news to you. This is things you're knowing. However, out of the 6 million retirees that we have, 35% of those retirees, over 2 million people, live below an OECD poverty line. They don't make a confident and convenient metric that's comparable to the other 23 countries in the OECD. It's unfair and it's actually totally unnecessary. So we're an aging population, as is a lot of the world, as is a lot in Asia Pacific. We have 6 million retirees today. 7 million by 2030, and we'll have 9 million by 2040. Now, our current model is based obviously on the working to retiree ratio. In 95, it was 17 to 1. If I said to you today, what is that ratio of 17 people working for one retiree, I'm not sure many of you would say it was 3, but that's what it is. And in Asia Pacific, it's heading to 2 and it's heading to 1. Unstoppable demographics unless there's something like a pandemic or a world war. It limits the scope of pension models to keep pace with the aspirations of our retires and retirees. So let's have a look at reverse mortgages. What is a reverse mortgage? Conversion of home equity into a source of income, offers interest repayments at the end of the loan, and the maturity is when the homeowner just vacates the property. They're customizable. You can have lump sum, you can have regular payments, or access via a line of credit. Usage-wise, it's almost anything. Living expenses, debt consolidation is now right there with the changes we've seen in the last 18 months. Property upgrades, suitability, investment, gifting, celebratory and experiential, obviously. Now, the supply factors in relation to reverse mortgages are quite simple. The banks withdrew in 2018, pre-regulation review, and the supply has been filled by 5 private lenders, of which Australian Seniors Advantage Group is one of them. The government itself has its own scheme. They're very pro this product. They have a home equity access scheme, which is previously called the pension and loan scheme. It's got more regulation around it, and it's grown dramatically. In 2024, there are now 12,100 participants with a lending of over 340 million. And it has greater regulation. Demand-wise, there are 3 factors around the demand for reverse mortgages. Demographics, the growth in population, the regulation, no negative equity guarantee, rights of permanent residency, obligatory legal advice, and fit for purpose is all part of that change. Culturally, the mind shift of retirees has changed. They're living well. They want to live better in retirement. They expect more. Now, internationally, we have a 1% penetration of the seniors market in Australia. We follow, very typically, the US and the UK. They have a 5% share. That 4% difference is worth $300 billion if we just settled it today. So demand is not the issue. So let's just have a little look at property in relation to the underlying asset. Supply and demand factors in relation to that. 2.2% organic growth in our population, 4% growth in our skilled migration, all looking for homes. 518,000 net migrants last year, 375,000 this year. We have a lack of housing supply and low building approval. So again, the property asset is secure. Investor participation. We have 4 note classes from 12 months to 48 months, up to 7.85% return. We're looking for a first series release of $100 million with 50 million already gained. Our LVR is 16.2%, and the minimum investment is 50,000 for wholesale investors. Now, our loan book in the Australian Seniors Advantage Group is 50 million with a 250 million security of prime property that exists already. More to go through, obviously. I'm also out there and would love to speak to you. It's a marketplace that's, I think we all know about. It's crystallising it. Today is about giving you participation. Thank you.
Thank you, Paul. Now please join me in welcoming Craig Anderson, Executive Director and Head of Funds Management at Princeton Financial Services.
Hi there, everyone. Craig Anderson. I'm the founder, one of 2 founders of Princeton. We're known as a non-bank lender. We fill the space that the banks have withdrawn from. Our niche is construction funding, and our primary areas of lending are residential development. We only do predominantly within our funds first mortgage lending. And we fund typically land subdivisions, townhouses and apartment buildings, but only up to a size of 100 apartments. I'll come back to why we do that size. Our typical loan to a borrower is $20 to $50 million. We love the Sydney market in particular. We do fund projects outside of Sydney along the eastern seaboard. But the predominant feature about Sydney that we love is the depth of the market. And I would give you an example. If you live in a street and the value of a house was being sold that was 10% below its market value, I'd guarantee you that someone in the street would buy the property. So we see the Sydney market as being underwritten to a large extent in the residential space, which is why we only deal in residential. We also think the way the Reserve Bank works with the five major banks counting Macquarie and the government, in effect, is a form of underwriting of the market. So first mortgage lending we see as probably the best risk-return investment that exists. And to give you some insight into that, over 10 years, we've delivered 11.61% return over that time frame. Real estate debt has become a very sexy topic, apparently. It appears in the media daily. Today's Financial Review did a story about, I think it was a Ray White family fund taking a new $50 million investor. There's been numerous non-bank lenders change hands over the last 3 months at prices well in above $100 million. But it's really not a new product. It's really just mortgage trusts, as they were known, which have been in existence since the late 90s. So I think it's the best risk-adjusted return area to invest. We also do equity funds where we do developments ourselves because we have investors who look for higher returns, and we're talking about 20% plus IRR. And we also have a diversified fund which invests in up to 10 of the SPVs. That's more an investment for wealth managers who don't really want to review information memorandums and make their own investment decision. They want a product to invest in. So the key issue for investors, as I see it, is that there's a plethora of players in the non-bank space, reportedly around 180. So how do you decide which of those managers you want to invest with? I think you've got to look, when assessing a manager, you've got to look at what's their philosophy, who are the people behind the business, what are their processes, and what is their track record. So just turning to a moment to Princeton's background and the reason it formed. My business partner was the head of property lending at St. George Bank, and he approached me in 2011 with this idea because mortgage trusts had crashed once in 1991 and once in 2009. You might recall they crashed because of a mismatch between the loan term and the investor's right to redeem funds. Loan terms were often 2 to 3 years, but the funds were offering 30-day redemptions. That's a complete mismatch. So when there became a run, whenever there's a credit squeeze, the mortgage trusts then crashed. So we created an SPV model where we do a $20 to $50 million loan in an individual SPV, lend that to a borrower, and the investor, so the term may be up to 2 years, maximum 2 years, and the investor were able to redeem their funds at that end of that 2-year period, 16 months, 18 months, depending on the term. So there was no mismatch. That's the same business we've been doing for 12 years in SPVs. And we still think that is probably the best investment. Wealth managers, as I said, and financial planners don't like that type of product because they don't want to read individual deals and explain it to their investor. But the high net worth market, family office market, much prefers to look at the SPV contributory model. The other thing about Princeton that was unusual is we started really just to manage the money of family and friends. We never had a website for the first 9 years of our business, and we've never advertised until today for $1 of investor funds. The second limb that I suggested that an investor consider when assessing a manager is to look at the people behind the business. One of the unique features of Princeton is that we have a staff of 12. 4 of the staff have development backgrounds. And that's quite essential when it comes to assessing a deal from a borrower. Because if a borrower says to you, I'm going to start construction of these 50 apartment building in 3 months' time. How do you know if you don't have a development background? A bank manager can't make that assessment. And I will put to you today that there are $2 to $3 billion in loans sitting in non-bank lending books where a construction hasn't commenced in the last 12 months, because that's a failing of the non-bank lender to understand construction, to understand the Design and Building Practitioners Act, the Building Commissioner, how to get an occupation certificate, how to get a construction certificate, all of those issues. So having a development background is a great asset for us to have. It also assists because we run 6 equity funds doing projects. We're currently doing a project of luxury apartments at Campbell Parade at Bondi Beach. We're doing 6 terraces in Balmain in an old derelict warehouse. We're doing 50 apartments in Rockdale. So we have a mix of developments across Sydney. But as I said, that's a minor part of the business. The third limb to look at is the process. What processes sit behind that lender? How do they really assess loans? So we have one unique feature, and I'd suggest we're probably the only non-bank lender that has a fully independent credit committee. They're not staff members. So we have 3 independents. And I'll go to them there. Who have no affiliation with the business other than reviewing deals. They must make a unanimous decision for a loan to be approved by Princeton. Beauty of that is the founders and directors don't get to make the decisions. We don't get to lend to friends. So it's a very arm's length process. We also use Perpetual as our custodian, and we've had them doing that role since commencement. And in our pooled diversified fund, they also act as our trustee. That's our track record over 11 years against the cash rate, 11.61. We recently underwent a review by SQM Research, which was quite an arduous process, as a manager as distinct from a review for a particular fund, and we obtained a 4-star rating. Hope that assists you. I did want to finish with one word of caution if you invest in this sector, particularly in the diversified funds. How am I going? I've run out of time. The word of caution is the reason property trust crashed in 91 and 2009, as I mentioned, was the mismatch between loan terms and investor redemptions. And I'm noticing a lot of the funds advertising now offering 30-day redemptions. That should be a warning, a red flag to investors. For example, in our pooled fund, you've got to have an initial term of 12 months and then you can redeem on 6 monthly rolls after that. So you can actually do a matching. But if you're offering monthly redemptions, I think it's a somewhat dangerous area. Thank you.
Thank you, Craig. Now, please join me in welcoming David Toomey, CEO of Deltine High Yield Motel Income Fund.
Well, thank you very much for having me, and thanks very much for coming tonight. So congratulations. Congratulations is in order, I think. If you're in this room, it's likely that you're a sophisticated investor, which means that you've accumulated a large amount of wealth over your career. You've been very smart. You've worked very hard. Now, for customers and clients that we have in that position, we usually say there's 2 rules now. 1, don't lose it. Number 2, make it work for you. And this philosophy is important for us, and it's important for the structure of the fund because it's our money as well. We are investing in this fund. The management team will invest in this fund. We'll invest 100% of our time into this fund, and we have a lot of passion for it. So please let me tell you more about it. So the fund will invest, it's a commercial property fund that will invest in over 50 regional and suburban motels throughout Australia. It's a very fragmented industry. There's a lot of opportunity in the industry. This consolidation play is not new. As you know, the pub sector, childcare, marinas, senior living, all been targeted for roll-ups. There's a lot of economies of scale available, whereas this one's relatively untouched. So why motels? Well, when you drive into a regional centre in Australia, on the main road in the centre of town, there's a motel. It's a fantastic location. It's a fantastic property. We're targeting properties of 30 rooms and up that have the adequate scale and have a history of operational track record and cash generation. So these aren't your mums and dads. These are sort of a bit more of the higher up after that. Now, the purchase yields available for this segment is over 10%, so fantastic, as you could agree. The essential service providers, so these are usually essential for service providers in their regions, in their towns, so very diverse local economies underpinning the operation. So the investment highlights, I'll go through this as we go through the presentation, but what to look at here is a greater than 20% return over the 5-year term of the fund. And as I said, you're stepping in to these acquisitions at a 10% per annum distribution yield. So as I said, priority number one, rule number one, capital preservation, low risk. And we've used this ethos as we structured the fund. Quality property-backed assets, usually in the range of $7 to $20 million that fly under that institutional bracket. And that's why there's an opportunity in this segment. Low LVR, we want to have a low LVR, about a 3 times interest coverage, diversification across geography and economies. The resilient operations, these things, as I said, when they're underpinning in a local town, mining, agriculture, business, infrastructure, local government services, there's that resilience of the clientele. We've instituted independent trustee and AFSL oversight, and we've excluded high-risk properties. So we're not doing developments, we're not doing turnarounds, and we're making sure there's no pubs and clubs in the mix. We're backed by strong advisors. It's very important to us, the fiduciary duty we have to our investors, to have a really good ring-fenced risk mitigation, very good tax-efficient structure, and very good compliance. Now, this 20%, it's a big number, it's a bold number, so let me explain that in a bit more detail. So as I said, the strategy is to acquire a portfolio of motels, quality assets between 6 and 20 million, adequate scale, and really good towns. And that's where our proprietary analysis really comes to the fore in terms of identifying these towns with a really diverse local economy. We do some optimisation during the term, and then the idea is to buy at a 10 or 12% yield and sell at the 8 or 9, once the 8 or 9% yield, getting that margin compression when you've got the portfolio. It's a vanilla buy and build strategy. Now, as you incrementally add up those returns, so you step in on day one at a 10% yield. Who wouldn't love that? I mean, it's fantastic. The first 3 months, we'll have a 100-day action plan to have a look at some basic operational drivers. A lot of these hotels and motels don't have dynamic pricing. They give away too much commission to the online travel agencies. They spend money where they don't need to. They don't provide upsell for food and beverage on site. There's a lot of basic things you can do without having to refurbish a site. And then the holding period is inflation-backed, and the great inflation-backed return provides capital growth and inflation protection. So room rates historically have grown every year with inflation, and then upon exit you get that uptick when you get that margin compression from selling a portfolio. So that's how we get to a 20 to greater than 20% IRR. In fact, this is an opportunity on the market right at the moment, and the modelling I've done, it's a $7.5 million motel with 38 rooms. It's got about a 34% IRR over 5 years. Now, obviously, I can go through the detail with you if you like, but I did a downside scenario where I took out the operational improvement, and it's still yielding over the 5-year term a 24% IRR. So priority number 3 is obviously making the most of that scale. But if we have a look at the problem we have for investors, generally, if you want to get into the property market, commercial market, it's a very time-consuming process, a lot of diligence, a lot of management, and a lot of research. And we can solve that problem by having a fund like this and also providing the diversification to you across a larger portfolio. In terms of the competitor comparison amongst other funds, I talk to investors who are looking at the portfolio, and things to consider when considering an investment for your portfolio is obviously the yield, the income distribution, the upside, the returns over the term in addition to the yield, whether it's diversified or a single asset risk, low debt levels, of course, or debt levels in general, whether it's development or turnaround, construction, and of course having that independent oversight and compliance. Now the industry has been going very well. The domestic industry has really been booming. The domestic travel industry has really been booming in Australia. There are over 2,400 motels in Australia. It's a very fragmented market, and the industry research is projecting a growth over the next 5 or 6 years by 2.5%. Now that's underpinned by the local tourism industry, just the local industry. I looked during the week. It's been growing at about 15% for the last 10 years. This is trips and stays and spend. It's really been going very well. So strong local demand, but also a shortage of supply. So construction costs are higher at the moment, and therefore a lot of these motels you'll be able to buy below replacement value. And then, of course, international arrivals are still growing strongly after COVID and recovering. There's also a history, as I said, of room rate growth that provides that inflation protection. So yes, our team motto is determination, focus, and execution. Execution is key in this strategy, obviously, because it is, as I said, a simple vanilla buy and build strategy. So assembling a team of executors. Just to point out, Craig Davison, he's 40 years veteran of the hotel industry as an operator. He managed Hamilton Island for 10 years, for example. He's the CEO of Journey Beyond that owns such attractions as Dreamworld and the Garn Railway. He's sat on the board of Australian Tourism. So we've got some good operational knowledge, and as you'll be able to see in the collateral, a team of successful execution. And the last piece I'd like to look through is just the structure, very vanilla, simple structure, ring fencing the property on one side and having operating assets on the other, a stable security so you'd own both with that independent oversight. So one thought I'd just like to leave you with is just the passion. Passion is the cornerstone of what we have here in terms of passion for execution, passion for creating the first and the largest owned and operated motel business in Australia. Thank you very much for your time, and look forward to you coming along the journey with us. Thank you.
Thank you, David. The next company is Sustainable Concrete Group. Please join me in welcoming its founder and director, Brendan Lloyd.
Hello, I'm Brendan Lloyd, the founder of Sustainable Concrete Group, and at SCG we have a couple of goals. One that's really, really important to me is greening up the dirty cement industry. And the second one, which has been touched on a couple of times tonight, is an ageing economy and the buying opportunities that exist in the market. So 50 billion tonnes a year is mined for sand. Sand is obviously a big part of the cement industry, and it's a hugely unregulated mining and resource product. And it's through that unregulated product, it's really damaging on the environment. So we have a couple of metrics that we want to use to few levers to use to change and clean up the cement industry. The first one is a partnership with a great Australian company called Alexum. Alexum is a solar panel recycling business based in Australia. 75% of the solar panels that are recycled, or 75% of the solar panel is a sand replacement from the glass of a solar panel. It's a really good business. RMIT, University of Melbourne, have created the data sheets and the safety and strength metrics there. The second point that is extremely important to us is the ageing economy and the businesses that are in the market up for sale at the moment. And we're purchasing these businesses at 3 times earnings, and we're looking to build a ecosystem across the whole supply chain of the cement industry. So I touched on there before, we've got the relationship with Alexum, we've got a quarry that we look after, we've got precast products, we've got trucks and pumps out on the road. All looking after each other and through the whole businesses. So one of the things that I think is really important to touch on is we're buying businesses that don't need fixing. So we're not a fixer-up business. We're looking for long-standing businesses that have been in the market for a couple of decades. The owner started the business, he's in his steel caps, and he's just built the business from a single-man band. And we're consolidating and giving the business an opportunity to keep the employment staff. So I guess as an outcome from tonight's chat, I'd love to just have a discussion with anybody in the room who is a debt provider. I'd love to align, your debt providing metrics with our broader vision and look for a larger, longer term partnership for acquiring these businesses. One of the things that's been really validating for me is the belief that this little business has built, and one of the team there that I've got, one of the more interesting ones is a guy called Adam Coffey. I read a number of his books. He's an American guy based out of Dallas, and he's a M&A, acquisitions dude. And I just nerded out and read his books and reached out to him, had a meeting and explained my vision, and that's evolved into a friendship and a mentorship and something that's, really comforting. The cement industry, it's pretty boring, it's pretty forgotten. A lot of people don't think about it, but they're unbelievable businesses in how simple they are, how profitable they are, how well they do. The challenge for the business owners and the ones that want to sell are the market, our sweet spot, our Goldilocks zone between 1 million and 5 million are difficult to sell, and that creates a buyer's opportunity for us. They're very simple businesses too, to be frank, and they don't focus on things like marketing and search engine optimization and the like. So there's some low-hanging fruit there to slowly improve. So these are a few of our check boxes that we like to look after and our sweet spot. I mentioned there before that our lower limit for our purchasing is $1 million and our upper limit is $5 million EBITDA. 1 million and above shows us as a group that the owners aren't operational. They don't, go to the work every day and run the businesses. $5 million and below is not interesting from a private equity perspective. So that's a really good sweet spot for us. 1 million above, there's less purchases in the market too. So less people wanting to buy the business a little bit small for mum and dad purchases. As I said, long tenure, been in the business for a long time, businesses that don't need fixing. So the deal strategy, I have set this business up to be not contingent to myself. I'm very comfortable with my skill set and my energy and my bandwidth. We believe there's a buying opportunity in the market at the moment with the businesses that we've got, and I want to be able to sensibly and controlled manage the scale that we're going after. So we've set up Sustainable Concrete Group to be a shareholder in these businesses, where we onboard managing directors to come on and partner with us, and their whole sole exclusive focus is their one business. So they look after their business, whether it's a quarry in Queensland or a factory here in Sydney. They focus on that, and then we get together and collaborate together as a group. That MD has the responsibilities and obligations that you'd expect from a managing director, whether it's ATO obligations, ASIC obligations, and then we grow together and manage and stabilise the business through the acquisition. I think a really important thing there is, although the business owners that are selling are not operational, they don't turn up to work every day, we negotiate a vendor earn-out clause into the deal so that we can just handshake with them and build confidence that although they're wanting to go on to the next stage of their life, we want to make sure that they're motivated to make sure that we succeed, I guess. So we ensure that the vendor's got a earn-out there, and then debt for the rest is really important and why we're here tonight. So, yeah. I think that's about it from me. I really would love to have a chat to you and just see if I can align our goals and your metrics and hopefully become a more recyclable, environmentally friendly cement industry. So thank you for your time.
Thank you, Brendan. Now let's watch a pre-recorded presentation from Hope Capital to be presented by its chairman, Steve Seeley. Let's watch this.
Hello. My name is Steve Seeley, Chairman and a founding shareholder of Hope Capital Limited, a company set up with my son Jonathan some 13 years ago. I'm here today to tell you a little bit about our company, what we do and how we have grown up over the years, and also explain to you about our current fixed income investment opportunity, which yields 10% per year over a 36-month period. So what do we do here at Hope Capital? Well, we are a specialist provider of non-regulated bridging loans in the UK of up to 18 months, secured by a first charge over a particular residential, commercial or semi-commercial property that we lend on. Bridging finance, as it's known in the UK, is an £8 billion sector and is used by property developers where normal banking arrangements on finance cannot be utilised. Established by our family money in 2011, we quickly grew using our own funds and latterly other high net worth and family office money. In 2018, we brought in our first institutional funder and then last year brought in our second. We are currently talking to 2 others. Since inception, we have lent over 300 million to our borrowers, and our loan book currently stands at £75 million. So why are we different? First and foremost, we have excellent people. Based in the northwest of England, we have an extensive team of 35 consisting of sales, marketing, underwriting, loan management, and together with our own HR and legal departments. Our unique approach to the market makes us one of the leading players in our sector, both in terms of customer satisfaction and award-winning service. Speed and surety of funding is our USP, unique selling proposition. And whether it be for a refurbishment, a capital raise or an auction purchase, we are one of the fastest funders in the market. That said, I always say it's very easy to lend money to people, but the hard part is how do you get it back? Well, at Hope Capital, we have an extensive risk mitigation strategy for all our loans. Each deal is secured against the first legal charge on the property concerned, together with personal guarantees on the borrower and a power of attorney over all their assets, should they default. Now, most of our loans are around 12 months and 80% redeem on time. Some borrowers do extend, and this is fine as long as we can agree new terms. But in the very rare cases that a borrower truly defaults, we act very quickly. We appoint a land and property receiver, seize control of the property and assets concerned, and sell them off at the very first available auction. Now, I must stress that these cases are very rare indeed, but we are proud of the fact that in over 13 years of business, we have not lost any capital whatsoever on any deal. A key fact is that we always define the exit strategy on any loan prior to the lend, and we monitor each loan throughout its term, paying monthly visits to the property in question, ensuring that agreed milestones are met by the borrower. We have further security by the fact that our average loan size is relatively small, around £300,000 to £400,000 each, and that we only lend up to 75% of the value of any particular property. We always, therefore, have at least 25% equity headroom in each loan. So how can you be part of our story? Well, Hope Capital is in the next phase of their growth plan, and we want to give you, as an investor, an opportunity to co-invest alongside us in our growth. We wish to grow our loan book to £100 million over the next 18 months, and to do this, we need to raise up to £15 million from high net worth individuals. This will be on a fixed term basis, fully secured until the end of 2026. And we will pay out interest at a rate of 10% per annum each and every quarter. The investment, which will be deployed over our loan book portfolio, will be secured by a set of legal documents, giving a debenture and first ranking over the relevant SPV, together with the comfort of knowing that our money is in each deal, and that in the unlikely event of default, Hope Capital takes first loss. So, in summary, we are going to give you the chance to invest in a strong, well-established company with an excellent track record. We are looking for a minimum ticket of £100,000, and we will pay interest quarterly at a rate of 10% per annum. We have our own money in each deal and offer security by debenture and massive headroom in the loan book. Our current loan book is in great shape and our pipeline is as big as it's ever been. If you would like to participate in this opportunity or would like further information, please do not hesitate to contact me using the on-screen details. Thank you for listening. I look forward to hearing from you soon.
Hello, my name is James Butler and I am the Managing Partner of Albermale Ventures. Today I'm excited to introduce our Greystoke Court development in Ealing, West London. With over 20 years of experience in real estate development, my team and I are committed to delivering a successful, high-value project that offers attractive returns for investors. Let me briefly walk you through the details of this project and the investment opportunity at hand. Greystoke Court is a well-positioned residential development consisting of 13 modern apartments. The existing freehold site is comprised of 47 residential flats, with associated visitor parking and 30 garages to the west of the site. Having purchased the site, freehold, in August 2023, we have secured planning permissions and satisfied the associated pre-commencement planning conditions to add 2 new floors on top of the existing 1960s block, creating 9 modern apartments, and to convert the loft space of the adjacent 1930s block into 4 additional apartments. The mix includes 2 studios, 3 one-bedroom units, 5 two-bedroom units, and 3 three-bedroom units. These homes will feature spacious, contemporary designs aimed at professionals and families looking for high-quality living in a thriving area of West London. The views across London are exceptional. Greystoke Court offers a range of attractive features, making it highly desirable for prospective buyers. Location. The development enjoys spectacular, uninterrupted views of Hanger Hill Park and the wider West London vista from the 4th and 5th floors, creating a unique living environment. Transport. It's a commuter's dream, with Hanger Lane and Park Royal stations just a 6-minute walk away, and Ealing Broadway only 16 minutes away. Security and parking. The site is secure with gated, vehicular and pedestrian access, and all units come with allocated off-street parking. Quality and warranty. Each apartment comes with a 10-year structural warranty, ensuring the long-term value and peace of mind for purchasers. Now let's dive into the headline financials. The gross development value, GDV, of Greystoke Court is 8.442 million, broken down broadly as follows. 7.62 million from the sale of the residential units valued at £743 per square foot. 666,000 from the residual 37 car parking spaces for private treaty sale. £175,000 from the existing Vodafone mast on the property, for which we have already secured an exit. 106,000 is allocated to the ground rent value of the freehold on completion of the development. We have an RICS Red Book valuation from both Capital Value and Lambert Smith Hampton, which value the residual current site value at between 2.35 million and 2.54 million, considerably less than what we purchased the site for. This gives us an extremely solid financial foundation to work from. The project comes with favourable planning terms. We have worked the planning gain ourselves. The community infrastructure levy is £79,500, based on the mayoral sill rate of £60 per square metre. Crucially, there is no requirement for affordable housing, which significantly enhances the profitability of this project. Additionally, Section 106 commitments are minimal, with only £9,000 allocated for car club memberships over 3 years. The project will be delivered in 2 key phases. Phase 1, construction of 2 new floors above the 1960s block to create 9 new apartments, the structure of which will be built in lightweight steel frame with SIP panels. Phase 2 is the conversion of the loft space in the 1930s block to create 4 additional apartments using acoustic flooring and stud partitioning. The entire project is expected to take 12 months to deliver, with a further 6 months allocated for sales, targeting final sales completions and investment return by June 2026 or sooner. We are offering an attractive investment opportunity with a fixed return of 20% over 18 months. Investors can secure their position with either a second charge, should they bring the entire raise, or through shares in the special purchase vehicle established for this project. The equity required is $500,000. Importantly, the first units are expected to go to market in July 2025, with sales completing by December 2025. Additionally, we are considering the potential sale of the entire SPV, which could provide an early exit for investors. This is an exceptional opportunity to invest in a well-located, high-quality residential development project, with planning approvals in place, strong financial backing, and minimal risk. Greystoke Court is poised for success. As the managing partner, I have ensured that this project is designed for maximum return with minimal risk, and with several layers of worst-case planning baked into the costs and timings of the project. With a clear timeline, secure investment structure, and a proven team, I am confident in delivering strong returns for investors. To summarise, Greystoke Court represents a prime investment opportunity with a clear path to delivering excellent returns. We're seeking £500,000 of equity investment, with a fixed 20% return over 18 months. My team and I are available to discuss any further details or answer any questions, and we are happy to set up one-on-one meetings if required. Thank you for your time today. I look forward to discussing how we can work together to make this project a success.
All right, and now let's get ready for our panel session, who will be taking us through private credit and yield. Please join me in welcoming our panelists and moderator, Francis MacDonald, co-founder and director at Capstone Funds, Chris Broad, director at Leftfield Capital Partners, Mike Davis, a founding partner of Causeway Asset Management Limited, Scott Girard, head of property and director at Sterling Property Funds, and Sam Sproats, executive director of funds management at Growthpoint Properties Australia.
Welcome to the panel discussion on private credit and yield, the topic of tonight. Private credit has been an increasingly popular asset class due to its combination of yield, security, and stability. It's been a hot topic because it's been forecast to grow both in performance and size, though some are calling for a bit more scrutiny on the industry. My name's Francis. I'm a co-founder and director of Capstone Funds. We're a boutique real estate debt fund, and I'm humbled to be joined by some very distinguished fund managers in private credit and in property tonight. I'd just like to invite each of you to introduce yourself, starting with Mike.
Okay, sure. Thank you, Francis, and good evening, everybody. It's nice of you to be out at this time of night to listen to us, so thank you. We've been operating in the private credit markets as we've defined them for the past 20 years. Private credit is not a new asset class per se. It's been around for more than 400 years. The Medicis have been doing it in Italy for that long. And so what we do is in terms of our businesses, we lend to growing businesses. So we're lending to the kinds of businesses that perhaps some of you folks have made your own money out of, and you understand the risk-reward profile of doing that. I'll leave my comments there and we'll get into it later. Thank you.
Sam Sproats is my name. I've had the opportunity to speak already. I'm the head of funds management at Growthpoint Properties Australia. We're an institutional real estate investment manager trading in Australian assets across the country, and very pleased to be here.
Hi, good evening. Scott Girard, Director from Sterling Property Group. We're principally a real estate equity investor focusing on value-add opportunities. across the Australian eastern seaboard. My background is both in real estate, debt and equity. So thank you for the opportunity to sit on the panel this evening.
Hi, I'm Chris Broad, not the former England cricketer. I also appear to be wearing exactly what I was in my mugshot. So it's my birthday next week, so I'll see if I can get a bit more in the wardrobe. So very briefly, myself and two partners in Sydney and Melbourne, we co-own a fund with Greg Paramore, who has been mentioned by Steve at the outset. So Greg will not mind me saying he is a veteran of the property funds management industry in Australia. Most recently, he sold a business called Folkestone Property Group to Charter Hall. He sits on the board of Charter Hall. He also sits on the board of the Sydney Swans, so at the moment he's very happy. And we basically concentrate on development finance with ticket size up to about $15 million. Greg, through one of his other entities, co-invests in our product offerings, and we focus purely on debt, but other parts of the business in the family office play in other aspects of property development finance, including equity, but we don't mix debt and equity.
Great, thank you, and happy birthday for next week. Now, Chris, I might start with you. Private credit is booming and seems to be in the media every day, which I think someone said is surprising for the asset class that it is. What unique opportunity does it provide to investors?
Well, I think there's a couple of thematics here at the moment. One is, the best competitors that you could wish for at the moment are the banks. Really, they just create huge opportunity for people like ourselves in the non-bank lending space, filling up a vacuum that they've left, particularly in development finance. I think the thing also to remember is we tend to tagline this with property, but property is really the security that sits behind the product offering. You've got to remember this is a fixed income product at the end of the day. You're investing investment principal, you're earning a yield, and ultimately what you're really banking on is the fact that you'll get a return on that investment, but ultimately the security behind it is a mortgage over Australian real estate. And as a security, one of the sort of unique factors of property in Australia is you can get other asset classes like crypto, like small cap stocks, and the volatility in their pricing or the value in those can erode very rapidly. Australian property is incredibly robust. So when you see downturns in Australian property, you talk about single-digit downfalls or teen level reductions in asset values, really nothing less or nothing more than that. The other overriding factor is that not only are you protected by downside risk on the underlying asset value, but also you've got this loan to value ratio that you're applying to your debt. So you still may be no more than 65, 60, 70% of that total asset value. So really you've got a very, very strong risk return thesis, and people are seeing that as an attractive aspect in their asset allocation. Yeah, but bear in mind it is a fixed income product. You are part of a lending product. You are not directly owning property.
Great, thank you. And we've just heard yesterday the RBA doesn't have a rate cut in sight, so certainly high interest rates are to stay for now. So I'm interested in your perspective, Mike, in this environment that the cost of capital has changed and therefore so has returns to investors. What should investors be expecting in terms of yield adjustments from this high interest rate environment and risk?
Yeah, well, I think we've probably already seen a lot of that happen, Francis. I think everybody's well aware. It's amazing how much the general public watches the RBA. I've been in debt markets myself for more than 30 years, and once upon a time I used to think that we were the only people who talked about it and watched it. But anyway, I think in terms of rates, to answer the question, and I'm not about to predict where rates are going to go. We've seen what the US Fed did, and we saw rates here in this country and in most Western democracies move up much faster over the last 2 years than they ever have in history. So you saw a big or a significant adjustment in terms of the cost of capital, both cost of debt capital, cost of equity capital, and everything else. And I think what's important then, and most of all the panel members to my right would be well aware of this as well, is that when you go in and price risk in an environment like this, you need to price it with a long-term mindset. There's no point in pricing it based on what interest rates have done over the course of the last couple of years in what has been an unrealistic environment. So certainly when we look at pricing opportunities in the businesses that we look at, the sort of return you should be getting at a senior secured level in what we do is in the low double digits. It's always been that way. That hasn't changed. So when interest rates, or base rates as they call it, or the RBA cash rate was near enough to zero 2 years ago, we were still writing loans at 13 and 14%. Okay. Now, a lot of lenders do have the opportunity, because they lend on a floating rate basis. Of course, they've drifted up with the way rates have moved up, and that's been an important feature for some funds. I think what's important, though, regardless of interest rates, is that based on the exposure you're taking, you're getting paid for the risk that you're taking.
Yeah, I share that experience in my fund. We've been relatively inelastic to the underlying cash rate, which has been interesting. Now, Scott, I'd like to also ask you, with your over 20 years experience in both property and fund management, and we've had discussions tonight about both property and private credit, how should investors be thinking about private credit versus property investment?
Yeah, I think it's interesting in Australia, if you have a look at the global institutional market, and picking up previous comments, that real estate-backed debt is really viewed as a fixed income product. I think what we've found here in Australia in the wholesale market in the last 24 to 36 months is it's been positioned relative to a proxy for real estate equity investment. And I think there's probably going to be a divergence between those views as direct real estate assets reprice and offer better attractive returns than probably what we've seen over the last 2 to 3 years, where pricing has really struggled on the direct side with interest rates resetting. So it will be interesting to see how it sort of plays out as the market matures in the wholesale space in Australia, an asset allocation around real estate debt with respect to a fixed income allocation as opposed to a real estate equity allocation. But I think, again, it's relatively in its nascency in terms of capital flows going into the sector. The sector's been around for a long time, but really the rates and the returns that have been on offer in the market over the last 24 to 36 months has probably seen a reallocation out of real estate equity into real estate debt. It's how sustainable that is relative to being a fixed income product. And I think that's what's going to be interesting, as I said, as real estate equity reprices and offers mid-teen returns in a falling rate environment. It will be interesting to see how investors sort of play that interplay between debt and equity on the real estate side.
I think that's a really interesting point. I'd love to come back to diversification. Certainly, private credit has been really popular as a diversifier, as uncorrelated to public markets. So I've certainly seen that globally as it come in as a greater stabiliser when the equities markets have been nothing short of volatile. But let's come back to that nugget. Before we get there, Sam, you're involved in direct property. So I'd love to know, from your perspective, what are the specific segments where you're seeing the most yield in your market?
Thanks, Francis. I'll put my investor hat on, my private investor hat on, I think, to answer that. What we believe you're after from an investment perspective is access to commercial real estate. You want access to investments that have re-rated. So Scott touched on that. I mentioned it before. The adjustment in price. So you're coming in at a very compelling entry price, and you can see what the pathway is forward. But from a private investor, you have limited capacity. And so you want to align yourself with an investment manager and managers that can access those opportunities. The funds management business has been around for 31 years and over 100 transactions in that time. And that is what we offer up to the private wealth investor group. So it's a re-rating of the market. Markets move in cycles. I touched on a counter-cyclical view previously. But you want to be able to move in and out of, or buy and sell in and out of cycles as well. The return profiles, if you can buy well enough and be patient to buy well enough are very attractive to investors. I think from Scott's comment before, I'd say there's definitely a place for both private credit and direct real estate in the market we are in and going forward. The banks are not changing their attitude. So the private credit space is definitely well received from a private wealth and how they wealth investor group and how you can participate and get access to those opportunities. And then on the direct real estate, we're specialists in commercial real estate. The sectors that we would focus on would be the typical, the traditional food classes, industrial, office and retail and mixed use. And an example of that, and maybe from our own neighbourhood in a way that's a local asset, but Camaret Square, surprisingly at Camaret, but Camaret Square is a mixed use asset. Most would know as a retail asset. And we like property like that has a diverse income stream, multiple different sectors in. So in that, it's underpinned by a supermarket and it's got a lot of specialties and childcare, commercial, medical centre. And those opportunities, $50 million opportunities, needs a lot of capital and the right level of gearing as well to get access to those returns. That's a nice example of an asset that we own, that we continue to target. Someone mentioned before, like, where do you want to invest your real estate? I would most definitely be saying it's across the eastern seaboard, up and down the coast. Queensland's a very, very interesting place at the moment. Property growth, affordability, infrastructure spend, and we might even have the Olympics if they can build everything needed for 2032. Queensland's a market that we are keenly focused on. Likewise, in our own backyard, Sydney, New South Wales, but certainly up and down the coast.
I think that's been well proven over the last 30 years of growth on the eastern seaboard. Absolutely. Now, I'd like to move back into that point around diversification and the role of private credit and property in a diversified portfolio. Then I'd like to move on to discussing the risks, as we should all be aware in any investment. So as Scott, you mentioned before, private credit is often classed as a fixed income product. And over the last few years, it's really risen in popularity as a diversifier in portfolios because it's stable, it's uncorrelated. And some are even calling for this alternative investment asset to become the mainstream. I think KKR, an American firm, have actually recommended it should be 10% of everybody's portfolio, which is quite bold. So Chris, I'd like to ask you, how do you see private credit setting in investors' broader strategy in a volatile market?
I think, to Sam's point about choice, you've really got those opportunities in longer-term investment asset holds in property. On the private debt side, you can really kind of slice and dice this and actually pick out of it what you really want to choose from. So people love to talk about the property market as some kind of amorphous, generic thing, and it's just so far from that. It's, certainly in the development cycle, you're really going from sort of the planning land stage into construction, into completed assets. So you can make choices about where you want to be in that area. We have investors who want to play in land but don't want to play in construction. Some people want to play in construction because one of the speakers also talked earlier about a lot of land loans just really coming to maturity and then not finding a new home and moving into the next stage of the gears. One of the things that we really like about construction lending is that there is a proof point from an exit perspective. And if you know how to manage risk and you know how to manage construction process and you've dealt with all the things that can possibly go wrong, then we actually like that area. Other diversification comes through geography. We touched upon Queensland. People can be quite parochial about where they want to invest. They want to be able to drive past that site and see it in action. Other people are a lot more agnostic about that. Then you go into a layer where there are various property sub-asset classes. So, our chair and co-owner, Greg Paramore, sold a large childcare property portfolio to Charter Hall. That's one asset class in its own right. You then go between residential and commercial. Residential, I think, is pretty well documented, but commercial, really comes down to the quality of the lease covenant and the tenant at the end of the day, because it is a specialised asset. Childcare, you need an operator. Warehouse, you need somebody there. So you've really got to look at the quality of that operator at the end of the day to identify where the value in that asset is. And finally, I think the other thing is loan tenor. So duration risk. Everything that we do, we chop. If we are in a land loan and then we go into construction, there's a liquidity event at each phase, because we believe the characteristics of the risk change, and it does give investors the choice of when they want to come in and out of those particular investments. So even within this sort of asset class, there's huge diversity even within that people can pick and choose, and we think that's a really important characteristic to add to your offering to investors.
And I think through what you discuss, it really demonstrates the importance of the experience of your fund manager and how they can manage when things go wrong, which does bring us on to risk. I like the comment earlier about investing into private credit and being the best risk return that you can achieve. So let's dive into that a bit, as all investments do have risk. And Mike, I'd like to know your experience at managing both private debt portfolios at large institutions and at independent firms. How do you approach balancing risk and yield in private credit?
Yeah, that's there's a lot in that question, Francis. But I think that what any investor should be aware of when they're, as I've touched on before, when you're looking at the risk-reward trade-off in any transaction that you do, and whether it's lending against property-based assets or lending against business-based assets, that what you're doing is getting the right protections wrapped around the loan that's being done. I'm sure everybody on this panel would have in their investment approach what we describe in our business as the 4 C's. So when we're looking at lending to a business, we're looking at the collateral in the business, we're looking at the covenants that we apply to the loan, we're looking at the cash flow in the business, and we're looking at the character of the borrower, and that's a very important aspect of it as well. And those dynamics are actually very important then in determining what sort of risk-reward trade-off you should be reaching, and it then depends what part of the credit capital stack are you sitting in. So in our flagship fund that I talked about before, having a low double-digit return, we're sitting senior secured, so right at the top of the capital stack. So what I mean when I say that is that we're well ahead of equity, and we're getting equity-like returns for the kind of risk that we're writing. So that's what a risk-reward profile payoff looking attractive looks like.
I think I'm going to steal that 4 C's, especially around the character. That's a great catchphrase. Absolutely. And Scott, from your perspective, what do you see as the key risk factors that investors should look at and evaluate when they're looking at investing?
I guess from a debt side, it's all about the borrower to a large extent. It's a contractual asset class. The facility agreement, the terms within that facility agreement are hugely important. I think the first movers into the private credit market have done incredibly well to build scale. I'd be somewhat reserved around a lot of the new capital coming into the market, not saying that there's not room for that capital, but as you see more capital coming in, trying to pick up those returns, ultimately returns will come down as new capital bids for business. And one of those areas that can be sort of looked upon to try and win business is a facility agreement and introducing terms that are more borrower favourable than lender favourable. So I think that's a key consideration around risk. Pretty basic around borrower risk, track record, equity, security. It's relatively vanilla. And then you get into sector, geographical, the areas of the market that you're investing into or you're lending into, and then the obviously the geography. But I think for an investor's perspective, when we look at private credit deals now, we're really wary about the amount of money that's come into the market in the last 12 months off the back of relatively high returns historically and pretty attractive absolute returns, and just making sure that the facility agreements are still holding tight with respect to covenants and terms within those, and making sure that they are lender favourable.
What do you think the impact of that new capital coming into market is?
Lower returns ultimately. When you get a lot of supply coming into the market against, a level of demand that is growing, but not to the same extent at which supply is coming into the market, ultimately something gives, and it's typically risk or return. People take on more risk for the same level of return, or they hold their risk profile and accept a lower level of return. And I think ultimately that's where the market will move. And again, the established operators in the market probably have a first mover advantage and scale there to be able to operate off the back of those lower returns.
It's a really interesting point to watch as returns are at an all-time high. The size of private credit is forecast to grow exponentially. I know Prequin forecasts that the performance will continue to grow, but I think you make a really astute point around how will those dynamics in the market change. Now, Sam, you're in a different field than direct property investment, so keen to hear from yourself as well about what risks should investors be thinking of when they're looking at that.
Yeah, thanks. You can never do enough due diligence. You can never, ever do enough, whether or not you're doing due diligence on an investment manager and wanting to support what your investment manager is presenting. You also have the ability to say no, and it's for the investment manager to present the case as to why it's a good investment. If I put on my investment manager hat on one hand, again, due diligence is one of our specialties. We have a saying in the business that well bought is half sold. It's always about buying well, buying for unseen value and creating that value. And then the other point is you've got to be able to work and move through cycles on the real estate front. So we're always very much, we have a 3 C's as well. Our first C is cash flow. Cash flow obviously relates very much to what we're here for tonight, which is about high yielding investment opportunities. But it's complex. And from an investor to presented before, to acquire a $90 million asset is certainly out of reach for a lot of people. And so the way we structure it and create those opportunities for investors to leverage off what is an institutional model. And then, look, risk is everywhere. No investments without risk. So back to due diligence, from a manager perspective, it's track record and reputation, and you certainly can't buy your reputation. So that's the opportunity for yourselves to critique that and back the right people.
Great. Well, we've got about 5 minutes left, so I'd like to actually turn to the final thoughts for this evening and the advice that you would each leave for the investors here tonight. So, Chris, from your perspective, when an investor's looking at these plethora of options, what advice do you give them about what they should consider?
Yes, I think we've talked a fair amount about the asset class itself, and we've certainly touched on do your homework on your asset manager, because ultimately they're going to dig you out of a hole if there's a hole to be dug out of. And I can't stress enough the quality of the asset manager, their track record and their skill set around doing that is absolutely tantamount. I think the second factor is transparency. Get comfortable that you can see through that investment and are really clear about what the underlying asset is and what the underlying risks around it are. I think that's there's lots of different structures out there. You need to give yourself enough comfort that you can really understand what you're investing in. I think with the due diligence hat, it's not what you do just at the beginning, it's what you do all the way through. So that due diligence, particularly for the sort of work we do where we actually like construction, but it takes work and it's about putting the canary down the mine constantly. So, in our investor report, we do a page on every loan. There's photos when the last quantity surveyor was last out there, when the last claim was paid, when we were last there. Literally, we put it all out there, right? So I think it's all about understanding who you're dealing with, their competencies, and your ability to look through.
That's some sage advice. And Mike, from your perspective, what's your view on the outlook of the sector and where do you see the most promising yield?
Well, look, I think the sector, we often describe the private debt sector or the private credit sector as a very broad church, and, it covers numerous categories. If you just look at the percentages here on stage tonight, there's 5 of us on stage, and 4 of the 5 of us are all involved in property-based private debt strategies. As I said, we're involved in business asset lending-based private debt strategies. So I guess what I would say, Francis, is that diversification, as everybody knows, is the ultimate free lunch. And if you are looking at strategies that are going to provide income to you, I would definitely be looking across the various strategies. I certainly endorse the comments that Chris made in terms of all of the other due diligence aspects, etc., that you need to be conscious of. But I'd make sure that what you're getting is true to label. Okay, so what they say on the wrapper is actually what you're getting, and that does go to the due diligence on the manager. And I think that if you've got an appropriate mix of those kinds of exposures or strategies across a portfolio, you can build yourself quite a good, income-based, quite a good income base, whether it's for retirement purposes or ongoing living purposes.
Great. And Scott, your views?
I think there's just a couple of observations. Ultimately, you want to be with a manager of capital and not an allocator of capital. And what I mean by that is ultimately you're going to have some experiences that don't turn out as per your underwriting, and you've got to get yourself out of those as a manager and work ways to get back on track from an investment perspective. Managers get in and do that. Allocators typically observe. So I think it's very prudent if you are an investor to do DD, as Sam said, on the manager and work out what experience they have of working out issues. I think the private debt market, it's been well positioned as relatively risk-free, and no investment earning 10 or 12% risk-free. And so I think it's worth understanding the underlying assets, the underlying borrowers, the diversification, and don't chase excessive yield. Always be cognizant of risk and be prudent in terms of managing that risk, and just be conscious of that.
I think I'm hearing a common theme of DD on your fund manager, but also I think the transparency. I love the sticker on the label should say what's in the box, and then you should get regular updates around that. That's really critically important. So I think, Sam, I'll leave you with the last words for tonight.
Thank you. Last words of wisdom. Be patient, be diligent, be ready to pounce. And markets move, and we're in a cycle right now where we're coming out of the bottom of the cycle. You'll never pick the bottom, and we'll never pick the top of the markets. But now's a very exciting time from a private wealth sense of where you can get opportunities and buying quality real estate and quality debt products at a real discount or a great return. I think that's what tonight's all about. It's about finding the right high-yielding return for your investor money. And like I think David mentioned it very earlier, capital preservation. Worked hard to make that money, however it's been generated. Don't lose it. Back the right managers and generate some more wealth going forward.
I could not have said that better myself. So I'm right on time, which is incredible. So we'll wrap up there. I just wanted to say a very heartfelt thank you for you all for bringing your expertise to us tonight.
Thank you very much, Francis. And ladies and gentlemen, that concludes the presentations for tonight. Just like to say again, a big thank you to the panel for participating. As I said, we always love that we get diverse sort of perspectives, whether it be from the business side, residential property, commercial, industrial, and then obviously from the family office / residential as well. So please give another round of applause. Okay, now for a first time ever, we're finishing early. I don't think this happens very often at our events. So I know that almost deserves a round of applause, to the point that we don't have drinks ready yet. So on that note, I'm going to conclude tonight, but I'm going to say this. So all the companies that featured tonight that presented, they've all got trade tables at the back. And obviously this moves into the networking part of tonight. So for the opportunities which piqued your interest, make sure you go and have a chat with them. We do need to be out of this room by 9:15 p.m., right? So just make that really clear up front. So we'll have drinks and canapes coming shortly. And then following that, obviously, we're going to be networking until 9:15, then we'll finish. But please take the time. I said, every single one of these companies has either traveled, has made the effort to actually come be here tonight to provide this as an opportunity to you guys. More than that, as I said, exactly when I first started, everyone's got anywhere between 5 to 30 years of experience in this space. And as you can see from those presentations and also from the panelists, we do our best to curate to be in alignment with some of the perspectives they provided today. So on that note, thank you again, everyone, for coming. We hope you enjoyed tonight. Please, and also on the last part, please say a big thank you to my team. As I said, the wholesale investors, they do an incredible job to make this seamless for everyone from a attendee perspective, from a company's perspective, and even from me as the presenter for tonight. So thank you again and have a great night.